This conference will now be recorded.
Hi, and very good afternoon, everyone. If you can hear me, please share some confirmations in the chat box. I can see a few of you have already joined. Atul, Sarup, Arinban, Anirban, Akhilesh. All right, Srirag. Good afternoon, and thank you for joining in today's session. Today is dedicated to the Japanese candlestick charting techniques. We will talk about basic anatomy of a Japanese candlestick chart. We'll talk about some books which are suggested reads. We will look into few of the most repeated reversal patterns that we find over the charts over and over again, and they have a certain degree of reliability. We will also look into them from the software's perspective, how we can scan them on the software, how a software can be beneficial, how we can use a software to scan these patterns for us rather than we looking for them ourselves. That'll be a very interesting section. And then to end today's session, we'll talk about a very different, evolved kind of a Japanese candlestick chart, which is called the Heikin-Ashi candlesticks. So on. So we've got quite a bit of stuff to cover. It's going to get interesting from here on. The first two sessions, of course, is primarily about basic raw concepts. And from now today onwards, things will start to get a little more, I would say, interesting and practical indeed. Now, when I spoke about practical and interesting, I think it is time that we devote a little bit of our today's session on the usage of a software. It's very important. I'm not too sure if I've shared links of my YouTube videos wherein I've spoken at length about softwares. In fact, those who are keen can look into one of the webinars that I had taken, which is there hosted on Elon Markets. And we had talked about different types of softwares at length for over 2 hours. Nevertheless, I'm going to quickly break it down in just 10-15 minutes for you and talk about softwares. I'm going to maybe move them before the Japanese candlestick slides. Now, see, the technical analysis software is essentially a tool, a very, very important tool, a platform which will help you to analyze the market, right? It is like you have read books about how to drive a four-wheeler, and the four-wheeler itself is a platform where you practice driving. So in these kind of classes and books and YouTube videos and courses, you listen, you watch, you read about the markets, and software is a platform where you exercise that knowledge, right? Now, before I go into the softwares and how you should approach them, is there anyone amongst us who has been analyzing or trading the markets with the help of technical charts before this course, before this program? And if yes, can you share which software you've been using? Okay, by the time I get the answers, I will tell you that you should look into the software from a couple of basic perspective. Okay, first you need to answer a few questions. Okay, the question number one is, what kind of a trader are you? Okay, so let's say, are you an active trader? Or let's say, are you a passive trader? An active trader is one who is in front of the system all the time. This is essentially his active source of income. So this is his bread and butter. He is actively in front of the screen and he does short-term trades, he does intraday trades. Because this is his bread and butter. This is something that he is looking at all the time. Okay. Passive trader this is not his primary or main source of income. This is his secondary source of some income. This is his secondary source of income. This is not his main business. He need not actively scan the market, actively scan or track the markets. He may be into a job or a business, and this is his secondary passive source of income. He wants to create a portfolio of stocks. It can be a trading portfolio, it can be an investment portfolio. This understanding, this differentiation is extremely important. Where do you stand? Are you an active trader or are you a passive trader? This is the first step that you should answer yourself. Once you've answered them, okay, are you an active trader or a passive trader? If you are an active trader, number one, if you are an active trader, then of course you need an active software. You need a real time software. If you are a passive trader, you need not need a real-time software. See, you can go for, but you need not. Let's say you want to buy a four-wheeler to go to your office from your home, and you can buy a 10 lakh car, but if you have the money, you can buy a 50 lakh car. It's anyways going to take you the same time. So the passive trader need not buy a real-time software. Need not. I'm not saying don't, I'm saying need not, depends on your budget. This is not your requirement, but you have the money, you have the budget, so you can spend. So what is this main difference that is coming up between these two important terms? Real-time software, real-time, and in this case, not real-time is not known as or EOD software. So you can go for an EOD software. EOD software is end of day software. Real-time software gives you the data real time. When the market's active, it's moving, you get real-time rates, prices. EOD software does not give you real-time data. It gives you end of the day software, end of the day data. The markets gets over at 3:30, the Bhav copy comes around 5:30, 6 o'clock, and your software will be updated with the information in the evening. So when you come back in the evening from your business or what, you update the charts. When you open the charts, you will be able to see what happened today. But tomorrow, when you open the software during market hours, let's say 10 o'clock in the morning, your software will not, it will open the charts. Everything will be intact, but it will not show what is happening right now. This is the key difference between a real-time software and end of day software. A real-time software tends to be 2 to 3 times more expensive than an EOD software because of the data involved, number one. There's another set of questions that you need to answer, and this is also very important. That is, you have a large universe of stocks that you track and you trade, or you are, let's say, a very limited universe of stocks. Let's say you trade only the Nifty 50 and the Bank Nifty and maybe just 3 or 4 main index stocks. Is your list of universe, these stocks that you want to trade, is it limited or large? If it's limited, if this is the case, then you don't need a scanner. And if your universe is large, let's say Nifty 200 or more than that, then you definitely need a scanner. So two main things that you have to decide when you decide upon the software is, do I need the scanner and do I need real-time data or not? A scanner helps you to scan through 500 stocks in less than 1 minute, provided you give them the right information. We will do that. I will do that in front of you. I will make you do that, and you will experience how a scanner can be utilized. But then if you're only limited to the Nifty Bank Nifty and the 4-5 few stocks, so let's say even 10 stocks, then these 10 charts you're able to track actively every day. You don't need a scanner to scan 10 stocks, right? And so, keeping these a few pointers in mind, there are n number of options that we have in the market for a software. They will all have their pros and cons. Okay, they cannot be a best fit. Over a period of time, you will tend to create a certain bias for a software which you feel that, yeah, this works fine with my requirements. Okay, now Spider software Iris Plus is something that we will be getting from Monday onwards. We will get a demo of this software for a period of 20 days, which is very good. There are many softwares in the market. I'm going to quickly walk you through them without taking too much time. First of all, we have previously worked on TradingView.com. I'm going to first talk about TradingView.com in a little bit. TradingView.com is probably the best on the web platform in terms of your interface, the way the chart opens, the amount of different time frames, the amount of different ways, the amount of different indicators, the amount of data that they provide in terms of global data. They have a free version. They have a little bit of staggered version on the upside. You can pay and upgrade. But on the web, this is one of the main reason why this is my secondary software, why I use it, is on the go, on the web. This is the best. Means I don't need to carry my laptop or desktop if I'm going somewhere. Okay, all that I need, or let's say my Spider software sits on my desktop. It's got double screen. Now, if I'm going out for a month somewhere to spend a vacation, I need not carry my desktop. If I am using TradingView, I can access it from anywhere, from my tab, from my phone, anywhere. It does give real-time data. Earlier, it did not used to give futures data, but over last couple of months, they have started giving real-time data of the NSE futures market also. Okay, that's one. The downside of a platform like TradingView on the web, which is there, is it is directly connected to the internet. So in case you're somewhere where the internet is not as good as you would have liked to, then of course you'll not be able to access charts seamlessly. That's number one. And number two, it does not have a strong screener or scanner. It has a certain predefined logic inside their screeners. This above that, that above, that below this, etc., in terms of indicators. But these are all predefined. If you and I want to create a scanner of our own, then we will not be able to do that. Now there comes now the need for a scanner or real-time software. So there are many in India, like spidersoftwareindia.com. There's Reliable Software, there's Investor, and few more. Okay, you can check Reliable, Investor, etc. Now, from the very first batch of this program, we've been lucky enough to provide Iris Plus freely for a period of 20 days. This is something that you will get, every one of you will get for 20 days. Utilize it. Okay. On this software, I will use it today also to show you Heikin Ashi candles and the scanner. In this software, we get the charts, we can get it real time, we can get it end of day. So all the various combinations are there. The biggest strength of this kind of a software is their scanner. A little sneak peek of that we will get today when I'll show you this software. So The important thing is, please remember that you choose your software, or the software will choose you depending on your budget and depending on your requirement. And the first few years, feel free to do a little bit of testing and trying. Don't listen to me, don't listen to anyone who said this is the best software. Okay, don't go for it. Do not think that the expensive softwares are better softwares. I have personally used quite a few of them over the period of last 15 years. And then I've realized that for the purpose of my analyzing the charts, scanning a universe of stocks, creating some historical scanning, taking sessions like this offline or online and showing the students how you can use a software, and few other pointers, I have now on this date squared down upon Iris and TradingView. Earlier it was Iris and Metastock. I have used AmiBroker, I have used AdvancedGet, I have used quite a few of them. What I've done is I've tried and tested, and then more or less I found, okay, this is it. You know, you don't need to change your softwares, or you don't need to keep on experimenting all the time. At the beginning, there is a little bit of need for this experimentation or try and test. Okay. Last thing before I move on to Japanese candlesticks about the software. That is, I don't know if I've taken the analogy of you going to the driving school and learning how to drive, let's say 2 weeks, and you've learned how to drive, and now you have the driver's license and you will start to drive your car, right? I'm not too sure if I've taken this example, but let's say you don't know how to drive and this is what you've done. Now, when you go to this driving school and you learn how to drive for 2 weeks, you try out driving yourself in a very old Maruti Suzuki car or some kind of a Hyundai Santro kind of a car. Okay, let's say you have budget to buy a Hyundai Creta. You don't go and learn driving in a Hyundai Creta, right? You drive a Hyundai Santro, which is 7th hand old, and even if it gets damaged a little bit, it doesn't bother you or the institute who's teaching you how to drive. You get the point. But then when you've finished driving, when you've learned driving and you're confident enough, now you are, depending on your capability, depending on your requirement, depending on your budget, you can buy a Santro or you can buy a Creta. If you get the picture, the same logic applies here. We will use the Iris Plus software. We have used some bit of TradingView just to learn how to analyze a chart, run a scanner, find the best trading opportunity for us. This is like the trading classes, the driving classes. But then when the program is over and when you find, okay, fine, this is what the subject is all about, the driving. Okay, this is how the software is all about, that is the car. Now when you're more or less in a place, now you decide which software you want to buy for yourself, that is the car. It's completely dependent on you, whether you want to buy Iris Plus, TradingView, or nothing at all. Okay, so keeping these few things in mind, when we talk about the scanners again, the software angle will come again into picture. So let's straight away go now into Japanese candlestick charts and talk about how these candles are created. Before that, before I miss out, I would just shift it to this side so that there is no confusion later. So I can see your answers. Few of you are active, like Akhilesh is an active trader, Rajat is a passive trader, Pawan is a passive trader, but you have not mentioned software or anything. Like, for example, Akhilesh has mentioned TradingView. Anirban is using TradingView. Okay, Akhilesh is a Nifty Bank Nifty trader, so he's got a limited universe of stocks. Deep's got a large universe. So you can see there's a mix. Zerodha Pi is decent, but Zerodha Kite now has the integration of TradingView. So I don't think many traders use Zerodha Pi anymore. Okay, because Zerodha's Kite has the TradingView integration within itself, which is fine, which is completely fine. Many brokers will go for that. Fires was the first one to do that. IIFL is the recent one to do that. Upstocks have their own platform. So unlike unlike in 2004 when I started looking into charts, they were very limited softwares, and the brokers never were this technology friendly. Thanks to Zerodha, over the last 5 years, I would say almost all the brokers have tried to become technology friendly, and they are providing us with user friendly platforms for charts, for fundamentals, for options, etc. And over the next, I think, few years, it's going to get better. Okay. Bodhishat is asking, why is it profitable to sell options than buying them? Now, is this a question or an assumption? Now, you would hear this very common statement that you only make money by selling options and you don't make money by buying options. That is not necessarily the case, and we cannot make it into a statement. Yes, most of the time option sellers make money. Most of the time option buyers lose money. One time the option seller will lose money, or not one time, I would say rarely, or in few instances, the option seller will lose money, and in few instances the option buyer will make money. These are rare instances when the market trends big time, sharp movement in the market. That is where the option buyer will make significant money and the option seller will lose significant money. So it is not that we cannot make a general statement that it is always the case. What is the factual case? The fact of the matter is option seller makes consistent money more, but when it loses big. Option buyer consistently loses money, but when rarely they make big. It all depends on your timing, all depends on your strategy and various other aspects of options. Okay. Now let's move on to Japanese candlestick charts. Now, first few minutes we're going to talk about a little bit of basics. Japanese candlestick charts is an ancient concept, right? Over 400, 500 years old. And the Westerners, let's say primarily the traders from United States, thought that they were the father of technical analysis and they started this phenomenon. But then they were surprised to realize that Japanese traders, ancient Japanese traders, especially those who used to trade commodity markets like rice, used to keep a track and used to record the changes of price data. And so there's this person named Steve Nissen who visits Japan and finds out this unique charts, and he figures out some manuscripts. He manages a translator, translates the concepts, and comes back and writes some amazing book about the Japanese candlestick charts, which essentially introduces the Japanese candlesticks to the Western world. This happened with Steve Nissen's book. The first one which he wrote was the Japanese candlestick charting technique. Sorry, it's a little blurry. I'll manage a cleaner book cover next time. Steve Nissen. Steve Nissen is the name of the author. Stevenison. Steve Nissen. Japanese candlestick charting techniques. Wonderful book. The second book which he wrote is Beyond Candlesticks, which is this one, also very nicely written. You should go by this order. You should definitely read Steve Nissen's book, especially if you like to read. One aspect about Steve Nissen's book, which I love a lot, which I like a lot, and I go back to these books. In fact, I have it right in front of me in my home office, is every chapter he tends to begin with a quotation, with a proverb, a Japanese old saying. When we read this book, you'll sense a feel about the Japanese candlesticks. Okay, Say, for example, chapter number 6 starts by saying something in Japanese, which translates to put a lid on what smells bad. Okay, so put a lid to what smells bad. If you think in terms of the markets, is if you look at a chart on the on your screen which doesn't look so good, which looks a little bad, either up to down or down to up, put a lid to it means you know, this is not where somewhere you would like to invest, or if you have a position, you should trail your stop loss and etc., etc. So Steve Nissen has written this book in such a manner which makes us connect to the psychology of the traders and how these Japanese candlestick charts are created. There's another book which I stumbled upon in 2005, yeah, late 2005 in Mumbai, was this book written by Gregory Morris, Candlestick Charting Explained. Now, this was very lucky for me. You know why? Because number one, in 2005-6 in India, at least in Mumbai, we did not get these books, and even we got them in Book Zone, which is outside CST VT station. They were fiercely expensive. I think they should be in 3,000-4,000 rupees even in today's date. I don't know what's the price today. So it was fiercely expensive for me at that point of time. And so I stumbled upon a nice book written by Gregory Morris, Candlestick Charting Explained. This had an Indian publication, Vision Publication came out with this book. At that point of time, I bought it for 750 rupees or something like that. And this is a no nonsense, no romantic, no proverb or anything like that. To the point, chapter by chapter, explains the various different types of candlestick patterns and how to use them. Gregory Morris, Candlestick Charting Explained. Okay. Now, candlesticks is something which is widely used. Let's understand this. It is also not very difficult to understand. It is widely available. Which is widely available, fairly common, easily reachable, easy to understand, easy to spot on the charts, do not tend to be that reliable, right? The reliability of these patterns will come down, have come down over a period of time as the mass understands it. And so, as we progress in this session and going forward later, we would try and understand which are the patterns which we will trade and which are the patterns we will let go, we will not touch, we will not trade. Keeping this in mind, let's first look into a basic chart. So let's say I have the daily chart of Infosys here open in front of you. This is essentially the Japanese candlestick charts. So I've used the hollow charts. This is how the real charts will look like. Let me explain the basics. Of course, for few of us in this batch, which is the case with every batch, there are always few people who know the basics. They have learned this somewhere. So for them, it will be a repetition. But for others who are completely new to the subject, let me just explain few concepts. So what you see in a Japanese candlestick chart and what are the few aspects that we will keep in mind is few terms. Few terms are important for us to get a feel of how these patterns are formed and what are they trying to tell us. Okay. So if you look at a typical Japanese candlestick, it will look like this. This is the lowest point of the price. This is the highest point of the price. Open and close. If this is open, then it has gone up and this is close, right? On the other hand, if this is open then it has fallen and it has come down, then this is close. In the current day softwares,
it's 2 o'clock.
In the current day softwares, these candles are color coded. Okay, so if it's a positive candlestick, if it's a positive colored candlestick, it means that the closing price is above the opening price. So the close is above the open. Nothing to do with the previous close, nothing to do with yesterday. It will be color coded green or blue or whatever, depending on the software, depending on your preference. You can change them also. On the other hand, if the market has fallen from its opening, the most important and differentiating factor about candlesticks, about Japanese candlesticks, is they are not paying much attention or importance to yesterday's close. They are only important in today's close vis-a-vis today's open. So if today's close is higher than today's open, it is a positive candlestick. If today's close is less than today's open, it's a negative candlestick. Now, few terms that I would like to define for you for us to understand these candlesticks better. If you take the highest point and you take the lowest point, the difference between the high and the low is essentially the distance that prices have traveled. This we will call the range of the candle. The range of the candle is the distance prices have traveled, high minus low. Next, the open or the close, the close or the open, whichever is higher or lower. If you look at this difference, this we will call the body. This cylindrical part is the body. Body is the difference between the close and the open, either positive or negative. The body of the candlesticks. Lastly, the section on the top over here is called the wick or the upper shadow. Means from the highest point of the day, how much did it slip down? That much will be created and we'll call it the upper shadow. This one is called the tail or the lower shadow. That is, how much did prices bounce back from the day's low? If it bounces a lot, then it will depend on the open and the close, how much is the length of this lower shadow. So we will notice here that there are essentially 4 elements to a candlestick. 4 elements: range, body, upper shadow, and lower shadow. And now when you look into the charts, when you take a look into any chart over here, you will find various different combinations of this. Few have a very long body, few have a very small body, few don't even have a body, like these. Few may have a very long lower shadow and a very long upper shadow. Few may not even have any shadows. And so there is a variety, variations of these 4 elements of a candlestick. The range, the body, the upper shadow, and the lower shadow. Green or red, that is positive or negative, depends on the close vis-a-vis the open. It depends on the close vis-a-vis the open. Now, keeping these things in mind, we see these variations, and all these variations, each and every candlestick on this chart is telling us something, is giving us some information. Yes, it is. The last candlestick, which looks like this on Infosys, is telling us something. And when we read this, considering what happened recently, considering this in mind, and now when we look at this in perspective, we get some information. Yes, we do. We have some information. And based on that information, based on that understanding, there can be a trade, there can be an opportunity, there can be a chance to make money. Now, when you read Steve Nissen's book, you'll find that these Japanese candlesticks and the way they are written have a lot of similarity, or they consider the Japanese art of war or the war itself into perspective as if it's a war, as if it's a fight between the bulls and the bears, and who's in charge and who has a larger ground to itself. Let's look into some examples, and then we will look into some patterns. Now, what I will do, this is going to be a little basic, but it will be very important to understand candlesticks. Let me draw some examples for you, some 5-6 examples I'm going to draw for you here. Let me draw the first one. The second one. Okay. And let's say another one. Say another one. You will notice that in these 5 examples, 5 cases that I've drawn here, I have purposely drawn them in such a manner so that the high and the low are the same. All of these 5 candles have the same high and the same low, which means that the range is the same, which means that the distance they have traveled is the same. But there's a difference in the size of the body. The first one, if you notice this one, the open and the low are the same, the close and the high is the same. This is called a positive Marubozu. Try and understand what happened that day. Where the market opened, it did not even come down a little bit below that. From the very opening, it started to go up. And that's why the opening was the low. And it stayed up throughout the rest of the day. And it closed at the highest point of the day. Means it has not even slipped down from the highest point. Open equal to low, close equal to high. Very rare indeed, does not happen all the time, every time on the charts. But you get the picture. You get the picture that whatever distance price traveled, the bulls occupied it completely. They did not even leave a single inch of land. They did not even leave one single tick. So strong buying, Marubozu. It's also called the shaved heads because it does not have any upper or lower shadow. Just the opposite is the negative Marubozu next to it. Open is equal to high and close equal to low. Just the same thing, but upside down. Strong sign of selling throughout. So you get the picture that the market was in a bear grip, selling. Now you look at the third one. I've not made into a green or a red candle, doesn't matter. But what matters is in the third case, you have certain degree of upper shadow. Means, what does it mean? It means that the market from the highest point could not sustain and it slipped down. It also has a lower shadow, which means from the lowest point, the price could not sustain at the lowest point and it bounced back. So it created a lower shadow. I've created a higher shadow, upper shadow, I've created a lower shadow. And then there is a sensible size of the body, a sensible size of the body. This is a decent candlestick where prices did travel a bit, and the prices, the bulls or the bears, depending whether it's green or red, they have occupied a decent amount of land. Now you come to the fourth one. Of course, they slipped significantly from the high. The bulls slipped. Of course, the bulls bounced back, or the bears lost from the low, and they managed this much of a distance, or this much of land at the end of the day. This much. This is what you have gained. But then when you look into the perspective of the total amount of distance traveled, that is a ratio of, let's say, the body to the range. If you look at how much is the body compared to the range, you see that this is insignificant. Means there is a tug of war. Means there's a lot of fight happening between the bulls and the bears, and neither of them are managing to create or hold on to their lands. The bulls are gaining, they're losing out. The bears are gaining, they are also losing out. And so the land occupied, the body is small, which implies that you're not too sure about the directional clarity, which is worse when it comes to the last example here, the doji. This is called the doji. Doji is where the open and close is the same. Now, rarely will we find it as exactly the same. Rarely, we do find it, but very rare we'll find it to the decimal point the same. But now you get the picture. You get the picture that prices traveled quite a distance up and down. But the end of the day, neither do the bulls have anything to show off. No land, no body that they occupied. And the bears also the same thing. No body or no land could they manage to occupy. So an extreme sign of uncertainty in terms of the underlying trend. Uncertain, unsure which way the markets want to go. The strength of the buying and the strength of the selling is quite similar. And so now when you look at a chart, and when you pinpoint at any candlestick, you will be able to at least write down, understand what happened on that day. Market opened at a certain price. It came down all the way down there, but then from the down point, from the lower point, it bounced back a little bit and it stopped. Next day also we saw the same thing, that the market bounced back from the lowest point of the day. Previous day it could not go above the open, but the next day it went above the open. So now you can understand, okay, from these lower points, market's bouncing back. The third day it neither go up nor come down. It was just a dull day, and all of a sudden big recovery. It opened, it barely created any lower shadow, and throughout the day it went up, and towards the end it slipped down a little bit from the high point of the day. So like this, at any candlestick, if you pinpoint, you will be able to at least understand what happened on that particular day. Fine. And so just like we did patterns in our previous class, where we had observed historically in the past when certain behavior shaped up over and over again, they had a degree of predictability. And similarly, on the Japanese candlestick charts, also there is a certain degree of predictability, and these are called patterns. In your curriculum, there are a few patterns which I'll cover now one by one. When we do the pattern, you will understand it better, what I'm trying to explain here. Aditya is asking about, can you repeat what, Aditya? This aspect which I just spoke about with the example of this part on the chart, if this is the one. So what I'm trying to say is, forget this part. Let's randomly go and stop at any part. let's just randomly back in the past, just stop at any part of the chart. Okay, just let's stop here. So let's say stop here, somewhere here. So over here, if you look at the red candlestick, will you not be able to, end of the day, will you not be able to understand what happened that day? It was a strong red, long red bodied candlestick, which meant strong selling, which meant for the next day, it should be bearish. You would have been expecting that it should fall more. But wait a minute, it did not fall. On the other hand, if you look at the green candlestick over here, it created a body which was as long as the range. So the market's not actually that weak that it seemed yesterday. It's probably giving us some different signal. The very next day, then you see that, wait a minute, it's got a higher shadow, lower shadow, and it's got a doji kind of a pattern. So market's kind of finding it really, really tough. This is from where it sold off. This is from where it bounced back. When it bounced back and went exactly to where from where it sold off, the selling again came. This is the polarity principle that we've done before. So what I'm trying to say is, if you look at any chart, if you look at any chart, or if you look at any candlestick chart and you pinpoint at any one candlestick, you'll be able to break down what happened on that day. You'll be able to break down what happened on that day in relation to what was happening previously. This does not mean you'll be able to trade. No, it's just the first step. It's just the very first step of you'll be able to understand at least what had happened on that day. That's it. With this understanding, now we will go to patterns. Let's look into a few basic patterns now. Okay. Is it advisable to sell options just before the expiry? Yes, because when you're selling options, I don't know why questions of options are getting asked, but I don't mind answering as long as they are at the commonsensical level. Yes, because when you sell options closer to the expiry, your theta kicks in well, so your premiums will decay faster, right? Bodhisattva, you can ask one question, the same question once. You need not copy paste every time. Okay. Thank you for repeating. Okay, just open gapped up. All right. Let's move ahead. So I'm going to do some basic candlestick patterns, which is there in your curriculum, and then once I cover them, we will find them on the charts automatically. We will scan them on the charts. Yes, we can find them visually, but then when you have a tool, why not utilize it? Now, there are many patterns in Japanese candlesticks. We're gonna do quite a few of them. So every pattern that we'll be doing will have two sides to it, a bullish reversal and a bearish reversal. On my left hand side, I will draw the falling market situation, which is the market is in a downtrend. On the right hand side, I will draw the situation where the market is in an uptrend. Now, it is very important for these patterns to have a trend, a downtrend and an uptrend, because they are reversal patterns. They will try to reverse the trend. So the first pattern that is there looks very simple. It's a very common pattern. It looks like this. It has a small body. It's got a long lower shadow, and it does not have a upper shadow. It does not have an upper shadow. This kind of a pattern, this kind of a price behavior can shape up at the top. It can shape up at the bottom also. When it shapes up at the bottom of the chart, it is called the hammer. And when it shapes up at the top of a chart, it is called a hanging man. Hanging man has a bearish connotation. It tries to pull the market down. On the other hand, hammer is bullish in nature and it tries to push market up. What are the attributes? Let's write them down. And if you wish to trade them, what should you do? Number one, it's got a small body. Number two, it's got a long lower shadow. Now this long lower shadow is 2 to 3 times the size of the body, which means if this is your body, this cannot be the shadow. It should be something like this, 2 to 3 times. Please note, if it is like 7 times or 8 times, it's not a very good hammer. Personally, I have noticed it becomes very difficult to trade them. A proportional hammer, which is kind of very clean, neat, would be something like this, 2 to 3 times. And these are tradable. You can practically use them. If the lower shadow is too long, it becomes very difficult to practically trade them. I'll show you how. So small body, long lower shadow. Number 3, no upper shadow. No upper shadow, or you can say negligible. It's so tiny that it's as good as not having it, something like that. Number 4, color irrelevant. That is, whether it's a positive candlestick, whether it's a green colored candlestick or a red color candlestick, does not matter. If this is what forms after a falling market, it will try its best to push the market on the upside. And if this forms after a rally, after the markets have gone up, this will try and pull the market down. Now, how do you trade them? To trade them, first of all, please remember, we are not going to trade candles as it is. What do I mean by this? We are not going to trade a single hammer. We are not going to trade a single hanging man. No. We are going to trade those hammers who has an edge, who has an extra positivity to itself. This we will understand as we progress tomorrow and in our next session. So please understand, do not trade a sole pattern. Just a hammer, 50% of them will go right, 50% of them may go wrong. So आपके खाते में क्या आने वाला है, you don't know. Do not trade any signal by itself only. Only trade those setups wherein there is a confluence, there is an addition of various setups. This is exactly what we'll do today, tomorrow, and next Saturday. So the rule to enter a hammer, I would say that wait for the high of the hammer to breach a little above the high. Once the little above the high of the hammer is breached, this is where you can look to buy, take a trade, and little below the low of the hammer, you should use the stop loss. Prices after a hammer will have a tendency, you will not find this very common, not very common, but is not that rare either. Prices will have a tendency to come back and tease the lowest point of the hammer. Okay, and then later on it will pick up. And then later on it can give you a breakout on the upside. Not always, it has a tendency like that. For the hanging man, it's just the opposite. I would suggest wait for the low to get breached. Wait for the low to break. Once the low is broken, this is where you would like to exit, or in the derivatives, you can go short. And for this kind of a setup, use a little above the high as your SL. Targets are something that we don't get from the candles, but I have noticed one thing. Very, very clearly, you will also find it over and over again. When this pattern has to fall, or this, let's say the hanging man has to go right, when the pattern has to go right, it will generally give you the height of the pattern. That is 1:1. It can give you far more, it can give you less, but this 1:1 aspect of a candlestick is very, very strong. Very, very strong. And that's why, and this is the reason why I generally suggest candlesticks are good for short-term trading. They are not tools of long-term or medium-term making or utilizing the big trends. They're very good. They're ideal for short-term trend reversals. Before I move on to the next pattern, try and understand why they are very good for short-term trend reversals and how they are. See what's happening in this case, in this hammer and hanging man example. One simple single candlestick, one day, one hammer is giving you the information, enough information that it can go up. It has a possibility of going up. One single candlestick, one day, just one hanging man is suggesting to us that prices can fall. Now let's understand this. Just one candlestick has this kind of power. Does it go wrong all the time? No. Does it go right all the time? No. But does it have a probability in it? Of course it has a probabilistic element attached to it. So there is a chance, and that's what exactly on that chance we have to monetize, right? So the candlesticks are powerful, very, very powerful when it comes to quick reversals, because just one day's price information, that's it. And when you compare it with the Western classical patterns, which we did previous class, like the head and shoulders and double tops and double bottoms, you notice that they took weeks and months to form. Of course, which is taking weeks and months to form will lead to a reversal which will be larger. Over here, only one day is suggesting you a reversal. So I cannot expect that one day's reversal will lead to a 1 year rally. So please understand, when you trade candlesticks, use them as short term. Generally, most of the time you will find 3 to 5 bar movement. That is after the pattern, 2 to 3 bars, maybe 4 or 5 at max, will move in your favor. Okay. The color of the hanging man, the color of the hammer, both are irrelevant. When I've written these attributes, these are applicable to both of them. This is not just hammer, this is both hammer and hanging man together. Okay, so the color of the hammer or the color of the hanging man does not matter. It can be green or it can be red. It does not matter. The red hammer can make the market go up. The green hanging man can take the prices down. Okay, so color does not matter. Bodhisattva, the main difference between the hammer and the hanging man, my friend, is what you missed out, is simply the previous trend. Hammer comes after a downtrend, hanging man comes after an uptrend. Apart from that, they are no difference at all. They are just the same. This is the main difference, the previous trend. So that's why when I was marking on the charts, I mentioned, look at the last candle and what happened recently. When you get this kind of a pattern after a fall, it's called a hammer. When you get this kind of a pattern after a rise, it's called a hanging man. That's the main difference. Nishar will look into examples later, but first let's move on further and let's do the next pattern, the next set of pattern. The next set of pattern that you have, again the same thing. First is a downtrend. The mirror image will be explained with the help of an uptrend. This is the key difference. Now we are looking at the opposite of the hammer. Now we are looking at a small bodied candlestick and a long upper shadow. Similarly, a small bodied candlestick here and an upper shadow. When you have this at the end of a falling price, this is called the inverted hammer. And when you have the same thing after a rising market, it is called the shooting star. Shooting star tries to bring the market down. It's a bearish reversal pattern. Inverted hammer is a bullish reversal pattern. It tries to take the market up. Same rules. I can write them down for you here. Small body. Long upper shadow. Same rules. This upper shadow 2 to 3 times the length of the body. Number 3, no lower shadow, no or negligible lower shadow. Number 4, color of the body irrelevant. So it does not matter whether it's a green candle or a red candle. Shooting star is the reversal pattern which I would suggest look to exit or sell once the low of the shooting star is triggered. And for that kind of a trade, you should always use the previous highs as your stop loss. In this case, go above the high, little above the high once the high is broken, and little below the low is what you will use as stop loss. Between the hammer, hanging man, the inverted hammer and shooting star, you will find that there is a larger reliability. There is a tendency of the hammer working out better than the hanging man, and the shooting star to be working out better than the inverted hammer. Shooting star has an edge compared to hanging man, and the hammer has an edge compared to the inverted hammer. We'll find all of these on the charts and we'll figure out. Next is also a very interesting and common pattern which you will find on your charts. It's a downtrending market, and day one is negative, means the market has fallen along with the trend. Now please note, I have purposely drawn this candlestick red. Earlier I was not using any color because color was irrelevant. It did not matter whether it's green or red. Now it will matter. Now this candlestick has to be red in color, it cannot be green. So it's a falling market, and day one the market falls more. Next day it opens lower, but it bounces back and recovers everything. It's a strong reversal, strong buying, recovery. It engulfed the entire body of the previous red day. This is called a bullish engulfing. Fairly common, works decently well. Bullish engulfing is a bullish pattern, as the name suggests. The way to trade this is go above the high of the pattern. So it will try and push the market up. So the way to go for this is go above the high of the second day. Go above. This is generally higher than the first day. And use the lowest point, whichever is the lowest point, as your SL. The lowest point can be day one, the lowest point can be day two. But the important thing to note here, the most important thing to note here is the body should engulf. If this is day 1, if this is day 2, then this is not an engulfing. If this is day 1 and this is day 2, then this is an engulfing. You will not consider the shadows. You will only look at the bodies. So the body of the second day should completely engulf, cover the body of the previous day. That's called engulfing pattern. The bullish engulfing forms after a downtrend. The bearish engulfing will form after an uptrend. The market is in a rally mode. It's going up. Going is good. And the first day is green in color. It's a positive candlestick. But next day, it opens higher and it sells off completely and engulfs the previous day. The body of day 2 covers the entire body of day 1. This is called bearish engulfing. Bearish engulfing. Bearish engulfing will have the tendency to drag the prices down. You can exit or sell below the low of day 2, day 1 and day 2. So low of day 2, and use the highest point as your stop loss. You will notice here in this engulfing, it's a 2 candlestick pattern. Now we have moved from one candlestick to the next candlestick. The first set of candlesticks that we did was made of just one day, one day, one pattern. But now 2 days together make one pattern. It's a 2 candlestick pattern. So bullish engulfing and bearish engulfing. Okay. There is another variation of this engulfing pattern which is not there in your curriculum. It's called the piercing line and the dark cloud cover. You can check it later. Piercing line and dark cloud cover. But the next pattern that you have, and it's a very powerful pattern with a very funny name, is when you see a downtrend like this, and on a downtrend, the first day is negative, but the second day is a small bodied positive candle within the body of day 1. The mirror image, the opposite of it, is in an uptrend. The first day is a green positive candlestick with the flow of the market, and the second day is a small red candlestick, small body, very small body, inside the body of day 1. This is a very, very powerful pattern, very powerful pattern. The left one is called the bullish Harami pattern. The right one is called the bearish Harami pattern. It has got nothing to do with your Hindi slang of the word Harami. The word Harami in Japanese means pregnant woman. The pattern takes the shape of a pregnant woman, and that's why they use the word Harami in their language. It's called the pregnant woman. It's got nothing to do with the Harami word in India, so nothing to get too excited about it. But it is an exciting pattern. It is indeed a very, very exciting pattern. In fact, later on, when you look into the charts, you will find how reliable this particular pattern is. How this particular pattern tends to almost all the time give you a chance to make money. Almost all the time. The most important thing over here is to remember that the body of day 2 has to be inside the body of day 1. Smaller the body of day 2, the better. So if this is day 1, day 2 should be a small body towards the lower half. It can be in the middle half, it can be at the top half also, but it should be a small body. It should not be a large body like this. Smaller the better. The way to trade this, the bullish Harami pattern, the way to go for this is, there are a couple of ways. I'll just tell you one of them in which you'll be able to utilize it. Is go above possibility number 1 is go above the high of the larger candle and use the low of the smaller candle as a stop loss. And there is an aggressive approach where you enter above the high of the smaller candle and you use the low of the larger candle as your stop loss. This is also a possibility. There are 2 ways in which this can be done. I have found pros and cons in both. One is an aggressive approach, one is a slightly non-aggressive approach. In terms of risk, more or less, both of them turns down to be the same. If you're an aggressive trader, if you're a short-term trader, if short-term trades is your priority, then I would suggest go for the aggressive approach. Go above the high of the baby candle, the small candle. However, if you are a little more conservative and you want to wait for a confirmation, then you can wait for the larger candle. But in either case, we will see this on the charts. We will find this on the charts. In either case, we will find the reliability of how often once we find such a pattern on the charts, they tend to work in our favor. They most of the time invariably tries its best to give us a movement, and it does. We'll find that. The opposite goes for the bearish pattern. Does the pattern relates to the volume, sir? Yes, Nishar, there is a saying that in these patterns, larger the volumes, it is better. When these patterns are forming, when a hammer or a hanging man or a shooting star or a bullish bearish Harami pattern shapes up on these particular days, if the volumes are large, it's always a good pattern. That is what it says theoretically. When you come to the practical paradigm, you will find examples of large volumes, not so large volumes, low volumes, pathetically low volumes, and you will find that they work, they don't work, and there's a mix of all of them. And that is the key reason why I'm not focusing too much on volumes. But yes, theoretically it says it should have large volumes. Okay. In bearish Harami, if candle colors are interchanged, does it still hold? No, it does not hold. That's why I clearly mentioned that now I'm going to use colors, and the colors have to be intact. So if it's interchanged in a falling market, green and red, or in a rising market, red and green, no, it is not a bullish or a bearish Harami pattern. It has to be like this. Okay. The last pattern that we have in our curriculum is a 3 candlestick pattern. In this case, we will be drawing 3 candlesticks. In a downtrend, the first day is a negative candlestick. The negative candlestick denotes that the market is in a downtrend and it continues to fall. Day 2 is a very small, tiny bodied candlestick. I have drawn it in blue because, or let's say I draw it in black, or else there are many software which uses the color blue. So it's a small bodied candlestick. It can be green or red, it does not matter. That's why I'm drawing it in black. And the day 3 is a positive candlestick, which denotes bounce back. There's a 3 candlestick pattern. This is called the morning star. Let's understand the pattern. Number 1, red day with the flow of the market down. Number 2, small bodied, red or green does not matter, small bodied. And when we look at the body of day 1 and the body of day 2, they do not overlap. There is a space. The shadows can overlap. The bodies do not overlap. Again, when we look at the body of day 2 and the body of day 3, the bodies do not overlap. The shadows are overlapping. Clearly, the shadows can overlap, but between the bodies, there is no overlapping. You see, there is a space. This is very, very important. This is critical. This creates the morning star. The last point that to keep in mind is the close of day 3. The closing price of day 3 should be within the body of day 1. Go above the high of this day with the lowest point as your SL. Generally, stop losses tend to be wider because now we are considering 3 candlesticks. Morning star is a bullish pattern. I have seen personally good and pretty bad examples of morning stars where they have failed and of course where they have worked very, very well. In my personal experience, if I have to stick my neck out, if you tell me only show me, tell me, teach me one pattern to trade, I would stick my neck out and go with the bullish and the bearish Arami pattern. I find them to be the most efficient. Before we find them on the charts, let's finish off with the evening star in an uptrend. First day is a positive day. Day 2 is a small bodied day. The importance is in small bodied. The importance is not in the color, small bodied. And then the emergence of selling, which closes within the body of day 1. If you look at the shadows can overlap. The bodies should not overlap. Very important. Let the shadows overlap. But when you look at the bodies, they should not overlap. This is an important aspect about the morning star and the evening star. And lastly, day 3 closes within the body of day 1. This is a reversal pattern, which is the evening star. Evening star will have a tendency to drag the market down, and morning star will have the tendency to push the prices on the upside. So if you notice, we started off with 1 candlestick pattern, and then we moved on to 2 candlestick patterns, and then we ended up with 3 candlestick patterns. But these are not all. There are many. There are 3 white soldiers, 3 black crows, belt holds, Tasuki gaps, and it's a long list. You need not study the candlesticks from the perspective of memorizing the patterns. The most important thing is to understand what is happening within the pattern. That is, understand the psychology, the behavior of prices. And then you can take up 2 patterns at a time so that over a period of a month or couple of months, you have covered most of the patterns. Again, I would always suggest understand 2 or 3 or even 1 and practice it 100 times rather than knowing 100 patterns and not practicing them even 5 times each. It's always good you pick up 1 and you practice it as much as possible. Does it help in intraday, Akhilesh? Yes, to a lot of extent it does, but remember one thing, the moment you're dropping down to intraday, you're inviting noise. Because you're inviting noise, based on these patterns, solely on these patterns, I would suggest not to trade. We will understand when we add on indicators and setups in our next two classes. Then later on, when you find a hammer on your intraday chart, you will be able to evaluate yourself. Should I take this hammer? Should I not take this hammer? As of now, you stand right in the middle, 50-50. You know what is a hammer, but you're not in a situation right now to filter. What my approach of sharing the knowledge of technicals with you is like this. First, show you the theoretical angle. Then the reality is at times they work, at times they don't work. Fine. Say for example, hammer. I tell Akhilesh, spend 1 hour on the chart of Nifty and find out as many hammers as you can. He finds out 18 examples. 10 goes right, 8 goes wrong. Now, the 19th one comes tomorrow. Big question mark. Should we take this or not? Should we bet on this or not? What should we do? So the next step that I'm going to take up with you is filtration. Now that you know what is a hammer, now that you know how does a hammer look like, you also know at times they work and at times they don't work. How can you and I filter them out, whether to take it or not take it? That's filtration. Okay. We've not gone there yet, but with the passage of time, we'll reach there. Do scanner help you to identify patterns? Of course, they do, and I had told you that I will show it to you with the help of these softwares, how the softwares help you to find these patterns itself. First, I'll show it on TradingView, then we'll take a break, and later on post break, I'll show it to you on Iris software. So TradingView has this new section they had added 3-4 months back, the candlestick patterns. You can see here. So in TradingView, you can come to the indicators and strategies, and you can click on click on built-in. So you don't have to click on built-ins. It's anyways there, candlestick patterns. And then let's say you click on engulfing bullish, and you click on engulfing bearish, and you click on hammer, hanging man, Harami bullish, Harami bearish, and you click all of them. So based on the understanding of the charts, they will have it. Just give me 1 minute, please. 1 minute. Okay, I'm sorry for that. Just had to quickly take care of something important. So as you can see on my chart here, it has marked the areas, like for example here, it has marked the bearish engulfing. Mark the bearish engulfing. Says that this is the hammer. Says this is the bearish engulfing. Again, the bearish engulfing. It is marking this as the bearish hammer. I'm sorry, bearish Harami, and so on and so forth. Now, it's very important for you not to trust them prima facie right on your face. Okay, for a bearish engulfing, there needs to be a proper uptrend, which may or may not be the case. For a bullish Harami, there has to be a proper uptrend that may or may not be the case. So this kind of softwares do help us plot it, so we can find something. But whether we're going to take it or not, whether going to, so for example, this says as a bullish engulfing. Now look at the length of the engulfing candlestick. It is so long. It doesn't make sense to chase this. You can find them on the 15 minutes chart, like Akhilesh was saying sometime back. Do they work on the 15 minutes? You'll find in the 15 minutes charts also. But be it the trading view or the iris software that I'm going to show you post the break, use them not to trade, use them to figure out, okay, so on the daily chart, for example, see, this is not marked as a bearish harami. Why is not? Let's say the body has come out, is it? Open is 1235.95, here close is 1236, 1235, 123. This should ideally have come as a bearish harami pattern because it's an uptrend, it's a long green bar, it's a small red bar. The red bar body is more or less inside the body of day one, but their algorithm is such, the calculation is such that they're not considering this as a bearish harami pattern. This is more or less a bearish harami, but I know why they are not considering, because the size of the body is a little too much compared to the size of the previous day. So what I'm trying to say with this example is, yes, they are useful. They tell you what kind of pattern is forming where, but then take the last judgment yourself. Do not consider this to be a bearish engulfing because there's no trend. There's only two positive bars. So this kind of judgment, you need to keep it with yourself. It's good to use the software to find the perspectives, but then we filter ourselves the perspectives and find out which are the real trades that we can take, right? In the Spider software, it's in a different way. We can find this, but I'll explain that post the break. It's almost 2:56, 2:57, so we'll take around 3:10. So 10 minutes past 3, I'll join you, and I'm going to show you how to scan for these candlesticks on the Spider software, and then we'll go to the interesting Heiken Ashi and how you can trade, enter a trade, trail the stop loss, and use it as a trend following concept with the Heiken Ashi candlesticks. Okay, I'm going to join you 10 minutes past 3 o'clock. Thank you. Okay, so back now, it's 3:10 as we decided. So let's move on. I hope everyone is back from their respective breaks. I'm going to quickly take you to the Iris Plus software and show you how the scanning of candlesticks are done there. And then we go on to Heiken Ashi candles. Now to do this, I need to connect you to my desktop, wherein I have the Iris software installed. I don't use it on my laptop. It's always on my dual screen desktop here. So just give me a minute. There you go. I hope you can see my desktop now. Over here, I have the Iris software open in front of me. Few things I'm going to share with you later today. That is, you will get the free installation of this software at your end, starting from anytime this week for a period of 20 days. Please make the most out of this and use the software to evaluate and understand how a real-time software functions and what all benefits you can get from using one. I have 2 dedicated playlists on my YouTube channel for this purpose. I had created them over the period of last 3-4 years, and I'll share these playlists with you a little later. But before that, this is the Iris Plus software, wherein there is a section called Technical Query. Do not get too worried about such complex boxes with so many aspects, and it might scare you. Don't worry. I will walk you through these. I will make you scan these yourself. You will be able to do it. And I have videos on my YouTube channel which walks through each and every element of this technical query step by step. So don't get scared. So in this technical query box, which is the scanner of the software, this is the scanner. I can double click on any condition and I can go under C, candlestick patterns. Candlestick patterns. I click on candlestick patterns. I go to parameters. I can scan any time frame depending on your requirement. But let's say we stick to the daily time frame and don't do anything with the condition. Now you come to patterns. So when you come to patterns, there are many patterns that they have fed within the system. So there is hanging man, shooting star, hammer, inverted hammer, engulfing bullish, engulfing bearish. Then there is Harami white, black. So there are quite a few of these patterns which we have covered. Again, as I said, there are many others. So you add them, then you select the condition, you check this box, select it. And I am scanning it on the FNO universe and I run it. And there you go. 18 scripts have come up. Now, the downside to the Iris scanner is within the candlestick scanner, it doesn't tell us whether Apollo Hospital, what pattern it is, it doesn't tell us. It just says yes, yes, yes. Okay. So then it's up to us to figure out, okay, they are considering this as what are they considering this as a bearish Harami pattern? Because it's a positive candlestick, and within a positive candlestick, there's a negative candlestick body. But is this a strong trend enough? Not that strong. But they are considering this as a bearish Harami pattern. Similarly, Apollo Tyre, they are considering this as a bearish engulfing. But this cannot be a bearish engulfing because the bearish engulfing comes after an uptrend. This is a downtrend. So it looks like a bearish engulfing indeed. A negative body is engulfing a positive body. Indeed, it's an engulfing, but when we look into the trend, it's not an uptrend, it's a downtrend. So it's not a negative engulfing. Like this, the softwares will throw certain. So this is considering a hanging man. This is considering again an engulfing. This is considering a bearish Harami pattern. This is a bearish engulfing. So like this software throws possibilities. This is Infosys. Remember Infosys, we checked in TradingView. It did not come in the bearish Harami pattern, but see here, it is coming under the bearish Harami pattern. So like this, various softwares have their ways of figuring it out. We need to understand and appreciate one thing, that is, if everything was done by the software, which is pre-built, pre-fed, and all that we have to do is spend some money and subscribe to the software, then it would have become so easy to trade. But that's not how it is. This 18 scripts, all of us can get on our software. But then out of this 18, which one we trade, how well we trade them, how much returns we generate out of those trades, that depends trader to trader. This is what makes the difference. The software doesn't make the difference. The theory does not make the difference. Is what we do with the theory and the software. That is what makes the major difference. Nevertheless, we'll come back to the software and the technical query multiple times going forward. But now let's talk about Heiken Ashi candles. I'm going to plot Heiken Ashi on this chart, and I'm going to increase the space down below so that it's visible for you. This is the chart of Maruti Suzuki, or I'm sorry, Maruti. It's not Maruti Suzuki. The candlesticks on the top in blue and red is the conventional Japanese candlestick charts that we have discussed so far today. Okay. And below the lower pane in green and red is the Heiken Ashi candlestick. Heiken Ashi. Heiken means average. Ashi means pace, which means the average pace of the market. Taking an average or calculating an average is generalizing or smoothing it out or making it a little slower. Heiken Ashi candles slows down the pace of the market. If you visually look at this chart where Maruti's price action is plotted with conventional Japanese candlesticks and Heiken Ashi candlesticks, visually you'll find few aspects very, very clear. I would suggest you take 2 minutes time, observe this in front of you, and put down your own observations, your own visual observations. What do you see? What do you find is different, unique about the Heiken Ashi? Take a couple of minutes time and share your thoughts with us. Heiken Ashi doesn't have dojis. Aditya, no, they have dojis. I'll show you. Abhishek, well-defined trend, that's correct. It does show a clear, well-defined trend. Akhilesh, in lower chart, there is only one side shadow. Not necessarily, there can be two-sided shadows also, Akhilesh. I'll point them out to you. The change of the trend indication by Atul, yes, indeed, it does give us an indication. Majority, yes, majority of them. So we'll look into that point of Abhishek, of Akhilesh, I'm sorry. Uptrend green, downtrend red, yes, that's the trend. Trend clear in Heiken Ashi, Nishar, yes, exactly. In an uptrend or downtrend, it reduces the noise of mixed candlestick colors. That's right, Rumku, because it takes an average, and that's why in an uptrend or a downtrend, it reduces the noise significantly. So I'll start with this last point, and let's take up each and every point moving forward. First, it's very smooth. You will agree to the fact that it is very, very smooth. Series of greens, series of reds, clear sign of uptrend or a downtrend. When you compare this with the conventional candlesticks, it will be a mix of reds and greens, which makes it very difficult. So reduction of noise, number one. That is the main work of Heiken Ashi, average pace. Why are we taking an average? To reduce the noise. So what you're trying to do is being taken care of, reduction of noise, number one. Number two, sorry, there will be cases. Now let's focus on the Heiken Ashi. There will be cases wherein you will have only one-sided shadow or both-sided shadows. If you look at a strong uptrend, you will find the lack of lower shadows. You see, there are no lower shadows. Or when there is no lower shadow and the candlestick is green in color like this is a sign of a strong uptrend. On the contrary, when there is no lower shadow, when there's no upper shadow and the color of the candlestick is red like this is a sign of a strong downtrend. The other way to read this is, if you find a Heiken Ashi which is green in color and no lower shadow, it indicates bullishness. On the other hand, if you find a Heiken Ashi candle which is red in color and which has no upper shadow, this indicates bearishness. Indicating bearishness does not necessarily mean it will fall. It can fall. Indicating bullishness does not necessarily mean prices will go up. Of course, there will be mixtures, but we need to read, we need to analyze what it is trying to tell us. This is what it is trying to tell us. So we get an understanding of a bull market, or let's say a bullish market and a bearish market. Of course, there are dojis. Of course, even in Heiken Ashi charts, you will find dojis like we have here. But one thing you need to understand, that all the Japanese candlestick patterns that we discussed, or the Japanese candlestick patterns which are there in the subject, they are not applicable to Heiken Ashi. So you will not find a hammer, a hanging man, a bullish, bearish, harami, or engulfing. None of those patterns are applicable to Heiken Ashi. But we do find Heiken Ashi candles which are very similar to dojis, or we do find Heiken Ashi candles which are very, very small bodied with both the shadows. We just spoke some time back that no lower shadow is a sign of bullishness. We just spoke some time back that no higher shadow is a sign of bearishness. So when we have both the shadows, lower and upper, this is neither a sign of bullishness nor a sign of bearishness. This is kind of a tug of war kind of a market. The prices haven't decided a strong directional clarity. We can look at it in this way. These are the three types of Heiken Ashi candles you will find on the charts. It's smooth, it reduces noise, it tells us whether the markets are in a bullish mode, it tells us whether the markets are in a bearish mode, and it also tells us whether markets are kind of undecided, doesn't know which way to go. This is how the Heiken Ashi at least visually looks like. Now the most important thing is, How do we monetize it? How can we trade these Heiken Ashi candles? Can we trade them? That's first question number one. Are they tradable or not? If they don't give us any patterns, at least the Japanese candlesticks were giving us some patterns, some engulfing, some harami, something or the other. If these guys are not giving us any such clue and just representing the price in a smoother manner, but I cannot monetize, what's the point of it? Okay, so now let's look into it. How can we trade them? Aditya, Heiken Ashi never shows a gap. It never, because every Heiken Ashi chart opens with within its previous candlestick. So Heiken Ashi will never show you a gap. Heiken Ashi shows no real-time price. Indeed, they show real-time price. They will show real-time price. Now, to explain Heiken Ashi, its trading pros and cons, I always take, there are many examples, but I always take the example of Maruti and try and explain this to you with the help of this example. Okay. Or should I try and show it to you on TradingView, because TradingView will allow me to make a lot of drawings. Maruti monthly chart and Heiken Ashi chart. Fine. So let me first show you the good side of Heiken Ashi, the beautiful side of Heiken Ashi, which will make you think, wow, using this I can make a lot of money. This is what you will get the feeling first. And then I will show you the nasty side of Heiken Ashi, which you'll think, oh, wow, it's not that great. In fact, it's not going to make us money. And then looking at both the good side and the nasty side, we will be able to come to a conclusion. What is this Heiken Ashi all about and how can we use it? So this is the monthly, the long-term chart of Maruti, which I have here. And I would like to bring your attention to this particular candlestick, this particular Heiken Ashi candlestick. This was the month of April 2014. And over here, it has created a green Heiken Ashi candle without a lower shadow. I will conclude that this is a sign of bullishness. If this is a sign of bullishness, and if prices continue to go up, shouldn't I buy? Of course, I should buy. So I decide to enter into a long trade, a buy trade, above the high of this Heiken Ashi. Once this high is breached, I will enter. And if proven wrong, if prices fall, then I need to have a stop loss. To find a stop loss, I find the nearest lower shadow. I find it 1 day back. I find it here. So I use this as my stop loss. So this is my stop loss. If you want me, I can make them little thicker. And at this juncture, on this month closing price, I get a prospective trade. Next month, the market goes further up and I am long. I have entered Maruti. I have bought Maruti. By the way, the price that I've bought into is close to 2000, 2005. Let's say 2000. This month ends, which is the month of May. When the candlestick finishes, I look at whether there is a lower shadow or not. I don't see any lower shadow. I don't see any lower shadow. I don't do anything. I sit quiet. Next month closes, I check for a lower shadow. Nothing. Next, no lower shadow. Next, no lower shadow. Next, no lower shadow. Next and next and next, no lower shadow. The next month, no lower shadow. And then finally, in the month of April 2015, I'm talking about after a year now, I get a new lower shadow. The moment I get a new lower shadow, I revise my stop loss up to this lower shadow, because my previous stop loss was this lower shadow. And after that, I got this lower shadow. In between, there is no lower shadow. So I did nothing. The very next month, there was another lower shadow, which was higher. So I revised it. Then next 3 months, there was nothing. The fourth month, there was another lower shadow. I revised it and revised it and revised it. And I kept on revising till December 2015. I entered in May 2014. And I kept on revising till December 2015. And the low point over here in December 2015 was 4,400. Right here, 4,400. The next month, which was January 2016, prices fell and I am out of Maruti. So from this point, 2,000 to 4,400, more than 100% return in one investment or one trade. I held on to it for 1.5 years. It was a great trade. And during this great trade, what effort did I do? What did I actually do to make this 100% return? All that I did was I looked for a lower shadow. No technicals, no fundamentals, no news, nothing. End of the month, check the candlestick and find, have you created a lower shadow or not? If you have not created a lower shadow, do nothing. If you have created a lower shadow, trail the stop loss. Okay, done. Now the market falls a little bit, and after 2-3 more months, hold on, there's another month, which is the May 2016. It creates a similar looking candlestick. Green Heiken Ashi candlestick with no lower shadow. Same setup. So I decide, okay, let's buy above the high of this. And where should be the stop loss? The nearest lower shadow, this one. So I take a decision to invest or trade above this high. The very next month, it gets triggered. I have bought again. The month ends. What do I do? Check for lower shadow. Do I have a lower shadow? Nope. Nope. No. 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 There I go. In the month of November 2016, I get a lower shadow. If I get a lower shadow, I trail my stop loss once, twice, thrice. After that, again a series of no lower shadows all the way up till March 2017. Stop loss trailed. Again, the next lower shadow in the month of, now we're looking at Feb 2018. New lower shadow. Did the same thing like we did in 2014, 2015. We did the same thing again here in 2016 till 2018. Point of entry was around 4,200. Point of exit was around 8,500. Wait a minute, another 100% or more than 100% return in similar 1.5 years time. And all that we did was what? We kept on looking for lower shadows. So if you sum it up, we are essentially talking about a period like this. We're looking at a period from around 2014 to 2018, around 4 years, 4 good years, done 2 trades. Both the 2 trades were over 100% returns. You would feel really impressed. This is the good side of Heiken Ashi. Now, let's bring your attention to the nasty side of Heiken Ashi. Now, what I'm going to do is I'm going to bring your attention to this part. Same company, same stock, same chart. I've not changed anything. All that I've done is now we will look from 2009 to 2013-14. Again, a period of 4 years. That was a period of 4 years. This is also a period of 4 years. Now let's look into it. How many times would we have got a signal? How many times would you trade? And whether those trades would have give us any kind of returns or not. So let's, sorry. Let's delete this. Let's also delete this. So let's bring your attention to this part of the 4 years. So let's say we focus first on this guy. So we were supposed to buy above the high of this candlestick, this Heiken Ashi candlestick. Prices did not go above this, so this trade never happened. Second instance is it gave here, so we should have bought above this candlestick's high. It never went above the high, so chance number 2 gone waste, as in there was a possibility, it never happened. Let's look at the next one is here, this one. This one meant we should have bought above this, which we bought in the next month. We would have kept a stop loss here as we had planned. 2 months it went without any lower shadow, we were fine. Then third month, all of a sudden it created a lower shadow and we are out. Now this gave us a little bit of loss from 1370 to around 1100. Loss number 1. Okay, let's move on. Next opportunity it gave us on this month. So we buy above here, first stop loss down here, trailing the stop loss till here, entered month number 1, 2, 3. On the 4th, 5th month we are out. On the 5th month we are out. We entered around 1400, we exited around 1330, so around 70, 80 odd points down. So since 2009, first 2 instances no trade, next 2 instances both of them loss. Next we got an instance here, should have entered above this high, never happened. Then got an instance here, this is the 6th possibility, entered above here, stop loss down here, trailed stop loss till this and this, again out of the picture, entered at 1680, out at 1580, around 100 points loss. So let's sum it up now. I think we got first 2 never got triggered, next 2 loss, 5th one never got triggered, 6th one again a small loss. So again a period of 4 years. Again a period of 4 years. Same stock, same company. 6 possibilities, 3 never got triggered, 3 got you triggered, and all 3 of them, yes, minor losses, but losses. And then after this phase of 4 years of frustration, you got this trigger. Will you have the conviction, the confidence to take it or not? Or I can definitely say no one will take that trade, because no one will have that conviction enough to take that trade. But the point is, we need to now understand what's happening. What is happening that the same concept could yield us amazing returns, whereas the same concept just did not give us any returns at all in the same stock, the same company, and within the same span of time also. And the same monthly chart, it's not that we are looking into, we are comparing monthly with daily or intraday. So the primary thing, the primary observation that you would have found out very clearly is the 2009 to 2013 was a range bound market. It was a non-trending market. On the other hand, the next 4 years after staying non-trending was an exceptionally trending market. Markets generally behave between these two nature, trending, non-trending. You can call it trending or consolidating. Consolidating is waiting for the next move, and after a move it will again go into a consolidation. This is the nature of price, and this is what we notice all over the charts. Any asset class, equity, gold, currency, commodity, cryptocurrency, any time frame, daily, weekly, monthly, intraday. This is the nature of price. So the critical differentiating factor is 2009, 2013, 14 was a range bound market, whereas 2014 till 2018 was a superbly trending market. And that is the reason why during 2014-18, this is the trending part, we got some amazing returns, and in the non-trending part, we did not get any returns at all. Clear? And so if this is clear, then a big question mark we should ask, is Heiken Ashi a good tool to identify a trade, or is it a good tool to ride a trade? Is it doing a very good job in identifying an opportunity, or is it doing a very good job in riding whenever the market trades, whenever the price goes into a strong uptrend, it is making the most out of it. It is milking out the max out of it. So you would have understood by now that it is a very good trend trader. It is a very good way of trailing stop losses and making the most of big long-term trades. It can be an intraday time frame also. We can go to the Maruti 5-minute time frame, and in the Maruti 5-minute time frame, you'll find that if there's a one-way move, it will work. So need not be long term. It's just one way run. If the market moves one way, Heiken Ashi will help us stay in the trend as much as possible. On the other hand, if it's a range bound market, it will not work because there's nothing to follow. There's no trend to follow. How can it trail? And so the answer is, it's not a very good tool to identify. You remember where we started? This is a sign of bullishness, we should buy. This is a sign of bullishness, we should buy, and then follow, right? This part is something we will not use. No. This part we can use. We will use the strength of the system, not the weakness. Now another question should come to your mind. Then how do we decide the trend? How do we decide which? Okay, you're telling me Heiken Ashi is a good tool to ride a trend, but before that I have to get onto a trend, right? Or else what the hell will I ride? Right? Exactly. So this is what we are going to do step by step manner. So when we did Japanese candlesticks, and now we're doing Heiken Ashi, we figured out the strengths and weaknesses of Heiken Ashi. We let go of the weakness, we stick to the strength. Next, when we move on further with indicators tomorrow and going forward, we will now figure out, by the time we are today's Saturday, tomorrow we do indicators, next Saturday we do the trading setups. That is, when we finish next Saturday, you will find out the point of entry. You will exactly know where am I going to enter. And then once you have entered a trade, and if the trade picks up big time in your favor, that is, it starts to trend, then you can revert back, you can fall back upon Heiken Ashi to ride the trend. So do not use the Heiken Ashi for trend identification. Use the Heiken Ashi as a good tool for following a trend, to trail your stop loss and ride it as much as it allows you to. But do not use Heiken Ashi to decide, okay, I'm going to buy this. Don't do that. What to do? Of course, this is day 3. By the time it's day 5, slowly it's like a jigsaw puzzle. I'm going to put in one after the other, and it's going to fit in. By the end of next Saturday around this time, you will be in a position to figure out where to enter, where to put your stop loss. The trade is on. And then if the trade picks up, few trades do pick up beautifully, then you know, okay, I've got a winner in my hand. Let's ride it. Let's make the most out of it. So this is the key thing which I wanted to share with you. This is the Heiken Nashi candlesticks. Now, this is something you'll find in all time frames. This is the Maruti 15-minute chart. This is the Maruti 15-minute chart. Can you see successive candles, Heiken Nashi, one after the other, and how the lower shadows are not getting reached? Look at this, beautiful. If you have managed to enter somewhere here, you would have got an exit here. Was it a trend? Yes. Did you manage to carry it? Of course, yes. What did you do? Nothing. Just trail your stop losses based on the lower shadows. That's it. So when there is a trade, there will be returns. Remember this very, very clearly. When there is no trend, this guy will not work. So the key job, the key task of the Heiken Nashi is 1 out of, or let's say 1 or 2 out of 10 trades will pick up. Most of the trades will not pick up. Most of our trades do not pick up. Each and every trade is not a rocket like this. But if we keep on trying, a small rocket, a stop loss hit, a bad trade, and then all of a sudden a big rocket comes. When the rocket comes, when the one-way move comes, how do we make the most out of it? This is how we make the most out of it. This is one way in which we can make the most out of it. There are other ways. Okay, of course, there are other ways, but this is, I feel this is the most simplest way to make the most out of it. So as Sunil is saying that, so Heiken Nashi is a good tool to find point of exit. The answer is yes. The answer is yes. It's a good tool to find your point of exit, provided you want to ride the trend. So you, let's say you entered this stock at this price, it went up a little bit, and you're happy with the profits. You do not wish to ride the trend, then there's no point. But if you wish to ride the trend, if you want to make the most out of the trend, then it is a good point for your exit. Okay. How to find the trend then? Akhilesh is asking. So this is something that we will extend further. Tomorrow we'll find out how to find the trend. But now that we found the trend, does it mean that we buy? No. So there are many angles to this, step by step, one after the other. I'm going to explain this to you as we move forward tomorrow. Do we revise the SL at red candles as well? Yeah, why not? We see, you don't look at the color of the Heiken Nashi. You just look at the lower shadow. The lower shadow can come in the red candle. The lower shadow can come with a green Heiken Nashi or a red Heiken Nashi. It doesn't matter. All that matters is the lower shadow. One could do this research selecting 3-4 stocks. Does real-time softwares do it more than 500 stocks and recommend us to buy? Not necessarily, Ankit. Even if you buy an end-of-day software, they will also give you all the stocks. It's not that real-time softwares will give you access to more stocks than EOD. No. If you allow me to take the example, I don't know if I have the page open. Let me check. Yeah. For example, I'll just take this example to explain this answer. The Iris Plus, which is a real-time software, and the Iris EOD, which is an EOD software, is exactly identical. Exactly the same. The only difference is one is real-time, the other one is EOD. That's it. Akhilesh, what to do at red candle hammer? Okay, Akhilesh, hammer means now you're talking about Japanese candlesticks. We are out of Heiken Nashi. So if you recall, no sir. Okay, I'll pause for a minute. You in this chart. Okay, okay, I understand. If you recall, when we started Heiken Nashi, I did mention that the Japanese candlesticks patterns, the hammers, hanging mans, engulfings, bullish, bearish, harami, etc., do not apply to Heiken Nashi. They do not apply to Heiken Nashi. So in this chart, in this particular chart, if you find something that looks like a hammer, if you say this looks like a hammer, this looks like a hammer, this looks like a hammer, it is not a hammer. It looks like a hammer. It will not work, or we cannot expect it to work like a hammer, right? So all the Japanese candlestick charts patterns are not applicable in Heiken Ashi. We cannot, because the calculation is very, very different. It looks like that. It is not that. So please be very careful. Don't get carried away. Okay. Doji, yes, in the sense that it does shows this kind of a doji, but again, it is best that you do not mix up the concepts of conventional Japanese candlesticks with the Heiken Ashi candlesticks. In fact, when it comes to Heiken Ashi candlesticks, just use it to follow the trend, full stop. Okay. So SL, should we stick to the monthly charts? Shruti Agarwal, no. As I said, again, these concepts are applicable in any time frames. This is the 15-minute chart of Maruti, and we just saw this example. It's applicable in any time frame, not only monthly, any time frame. I started off with the example of the monthly because it gives a very good perspective of understanding the strengths and weakness of the concept, but it is applicable in any time frame. Okay, these candles are calculated based on the open high low close of the current and the open and close of the previous. It goes through a formula through which these candles take this kind of a shape. They are different in nature, and that's why the conventional Japanese candlestick techniques are not applicable here. We have to consider volume here. You can, but as I have not mentioned, it's better that we don't. It's a pure price action. You know, people look at pure price based movement, only price and nothing else, no indicators. This is one such, only price and nothing else. That's it. So you may look into volumes, but as long as it gives you clarity, use it. If it gives you confusion, do not use it. So you will find at times you will get into some confusion. You will find high volume fake moves, low volume good moves. So it's better we keep it aside. If Heiken Ashi is giving an SL of say 2000 for a stock, and if I put it for 2000 and trend rises, but in between month price touches 1800, but the trend continues, do I have to exit? If it touches 1800, your stop loss is anyways hit, Akhilesh. If your Heiken Ashi chart tells the stop loss is at 2000, and the next month the market is on and it comes down to 1800, your Heiken Ashi chart anyways 2000 is touched, so you exit. So if the actual trend continues, that is after the exit, it can continue, it can fall, it can continue, it can do anything. But then when you're trading, you need to stick to your rules, right? So be it Heiken Ashi or candlesticks or anything, you stick to the stop loss that the chart is giving you. After the stop loss is hit, it can go up. If it goes up, you have to find a way to get back on board again. If it doesn't go up, falls down, you'll feel good. Acha hua yaar, nikal gaya, because it has fallen more. But at that point of the time, and the trade, you have to exit because you decided this is my point of exit. Okay? Because every time it's not going to happen that the stop loss gets hits and it goes up. Many a times the stop loss will get hit and it will fall also. Okay. Okay. So I think I've taken care of most of the questions. So with this, what we will be doing going forward, everyone, is tomorrow we're gonna touch upon indicators. Indicators, we will refine them. I have refined them for you, and it will be easier for us to figure out the trend, the momentum, the volatility of the market. When we combine these three elements of trend, momentum, and volatility, it will add us clarity. It will give us clarity about our entry of trade. Before I move out today, I'm going to share the playlists which I mentioned about the the Iris Plus software. So Iris software, your installation should ideally start from anytime next week. I will request our coordinators to connect you with Mr. Shubhadeep. He will guide you with the installation one by one. When you get the installation, I strongly request, it's a strong request, okay? Please go through either of these or both these playlists. The first one is in Hindi. My Hindi, I don't rank it very high, it's okay types. But there are 15 videos in this playlist, starting from Spider Software, Iris Plus, getting started, to how to plot a chart, how to change the settings, the tool settings, how to create a group, how to plot multiple charts, how to create groups, how do you create groups of your own portfolio, how do you plot the indicators, what is intraday tick data, alert query. And so the chunk of the software and how to, from the very first step to an advanced step, all these are explained in these 15 videos. Okay, it'll be really helpful for you. I'm not joking. I'm not saying that I have created, that's why. If you find some good videos on YouTube, similar stuff, you should watch it. I don't know if anyone else has made it. I have no clue. But if you have the software free at your end and you find like a user manual in video format, do use it. This is in Hindi, and there happens to be another playlist which is a little jumbled up because it's got Spider software, it's got some other bits and bits of other softwares also. That's why it's a little mixed up, which is this playlist. I'll always suggest go with the Hindi playlist because it's very concentrated to Iris Plus and only Iris Plus. I'm not bragging or I'm not trying to prove a great point about it, but what I'm requesting is we've got the privilege of using a software for 20 days free. We would love to extract the most out of this experience, and you will be able to do so only when you know how to use it. These videos will help you. A cheat sheet would be something like you play the video, I show you something like how to open a chart. Okay, you pause the video, you do it yourself on your software. You do the same thing as you saw on the video. You now do the same thing once, twice, thrice. Okay, now it has settled down. Now you replay the video again, watch another step, pause, go to your software, do that exact step 3 times or 4 times or once till you get it. Yeah, okay, now I know how to open a chart, I know how to close a chart, I know how to zoom out a chart, I know how to zoom into a chart. This, I think, should be, I don't know, 2.5 hours or if not more. This entire playlist is as good as one full-blown class with you, as if I'm taking an extra class with you on the softwares. So please go through them. Okay, please tell me your YouTube channel name. My YouTube channel name is in my name itself, so you can just go to YouTube and type my name, and this is it. You'll find it here. I can try and send you the link. I'm quite surprised that you have not visited, because from day one I've been requesting to view few videos. Nevertheless, it's better late than never. Please go through these. There's a certain reason why these videos are created, so make the most out of it. Okay, so there we go then. Tomorrow we meet 1:30, and it's going to be a very interesting session. We'll look into trend, volatility, and momentum with the help of technical indicators. All right, thank you for joining in today. Time for me to sign off. Tomorrow we meet exact at 1:30. Thank you. Enjoy your Saturday evening. Goodbye.